In this video, we're going to be talking about the federal capital gains tax in the United States, a brief history behind it, how it currently works, and how you can use the capital gains tax to save a whole lot more on your taxes. I'm Bradford of the Penny Pinter's Guide to Personal Finance, and before we start talking about the capital gains tax itself, we need to understand what exactly is being taxed in this instance when it comes to your capital assets. Now, income in an income tax is relatively straightforward to understand. Whatever you are earning on a regular basis, whether it's 1099, W-2, or you're running your own business, that income that you're generating is going to be taxed as income. Now, a capital asset, on the other hand, is some property that you own that you sell for either a capital gain or a capital loss. Now, one stipulation for this is that the property that you're selling cannot be part of a regular business or trade practice. Now, what are some examples of capital assets that you might have? Now, a lot of people have a car, that's going to be a capital asset, or your house, any sort of investment good that you have, whether it's precious metals, stocks, bonds, mutual funds, ETFs, all of those things fall underneath the umbrella of capital asset. And when you go and sell those, they're not going to be taxed as regular income. In fact, they're going to be classified separately as capital assets that you're either going to be making a capital gain or capital loss on. Now that we understand what a capital asset is, let's talk about the capital gains tax itself. Now, the federal capital gains tax first came into existence with the passage of the 16th Amendment to the United States Constitution in 1913. At that time, it was collectively joined together with the income tax. There was no differentiation between income that was taxed and capital assets that were taxed. That wouldn't come along until 1921 when there was a new law that was amended that actually differentiated assets that were held for 2 years or longer, and those would be taxed at a capital gains rate, and assets that were held for 2 years or less, and those would be taxed at the regular income tax rate. And then the next big change when it came to capital gains tax didn't occur until after 1929 with the stock market crash beginning the Great Depression. Now, at that moment, when the stock market crashed, there were a lot of wealthy individuals that for the next several years ended up paying no taxes at all because the losses that they experienced during the stock market crash offset all of their regular income, so they just weren't paying taxes. Now, because of that, they amended how the capital gains tax carry forward losses could be treated. So at the time, you could only carry forward a maximum of $2,000 of losses from the previous years into the next tax year. Now, it's changed since then, but that was the principle that has continued up until this day. Now, over the past almost 100 years, since the 1930s, not much has changed functionally with how the capital gains tax works. There's some increases, there have been decreases, fights about exactly how the capital gains should be treated, but for the most part, what we saw back in the 1930s is basically the same of what we have today, except for some differences in the actual tax rate and what rate is applied to you based on which income level you actually fall into. And since that brings us to today, how exactly do our capital gains tax work? So it's important to understand that the capital gains tax is differentiated into two parts. There are short-term capital gains taxes, and then there are long-term capital gains taxes. In the short-term category, we have any assets that you have that you've sold that you held for 1 year or less. Now, for any of those assets, whether it's stocks, you're doing some sort of day trading, or you're flipping houses and selling them inside of a year, all of those, while they are going to be treated as a capital asset that is being sold, and you're going to be paying a capital gains tax on them, the tax rate for whatever amount of money that you made is going to be equal to whichever tax bracket that you fall into based on your regular income tax. So even though it's still called a short-term capital gains tax, in effect, you are just paying like you would with any other source of income that you are making, and it is taxed exactly the same, but you are using some different tax forms. Now, on the other hand, a long-term capital gains tax is any asset that you have held for at least 1 year plus a day or longer. So that investment that you had, whether it's your personal house that you go and sell after several years, but we'll get to that later because there's some really nice things about your personal house when you go to sell it. But any sort of investments that you have, if you have a stock option with your company, things like that, if you hold it for a year and a day plus, you're going to be taxed at the long-term capital gains rate, which is a lot more lucrative and beneficial to you than the short-term capital gains rate. So here we have the breakdown of exactly how the long-term capital gains rate works. So there's 3 different tax rates that could apply to you: a 0% rate, a 15% rate, or a 20% rate. Now, this is still treated as a marginal tax rate, very similar to how our income tax rate works. If you're curious more on that, we'll talk about that at the end of the video. So here we have, it's going to be dependent upon your tax filing status, whether you are single, married filing separately, married filing jointly, or you're head of household. So you're going to pay 0% on your capital gains that you sell, If you make less than $41,675 if you're single or married filing separately, $83,350 if you're married filing jointly, and then $55,800 if you're head of household. Now, if you make anything above those with capital gains sales, then you're going to be paying a 15% tax rate all the way up to almost $460,000 if you're single, $258,000 per person if you're married filing separately, $517,000 if you are married filing jointly, and then $488,000 if you are head of household. Now, for any money that you make above those thresholds, that money is going to be taxed at a 20% rate, which is reflected in this chart. So you can see these long-term capital gains tax rates are much more beneficial compared to their brethren over in the income tax rate, where instead of paying a 15 or 20% tax rate with your capital gains, you're going to be paying all the way up to 37% marginal tax rate if it was treated as a regular income tax as opposed to a capital gains tax. And that's why many high net worth individuals, think Mark Zuckerberg, Elon Musk, any of those big billionaires, they are actually paying a much lower tax rate compared to if they were just taking all of that money as regular salary. So Mark Zuckerberg is a famous example. Each year, he only takes a $1 salary from Facebook. And then the rest of the compensation that he's getting, the majority of that is in stock options through Facebook itself, now called Meta. And because he's getting all of that money that is being paid through stock, that is all capital assets. So long as he doesn't sell it within the first year of receiving it, then he's going to drop the 37% marginal tax rate plus whatever state tax rate he's paying. That is going to drop down to the capital gains tax rate, meaning that even on the majority of the money, if he went and sold $1 million worth of Facebook stock, he's only going to be paying a 20% marginal tax rate on that stock, as opposed to a 37% tax rate that he would be paying if he received his compensation in the form of salary instead. So now that we understand a brief history, the difference between long-term and short-term capital gains, how do we actually use the capital gains tax to save on the taxes that we pay? One of the strategies here is known as tax loss harvesting. Now, a lot of big hedge funds, financial firms, if you have a financial advisor, this is something they're probably doing for you anyway. But for most people, that's kind of out of reach. So what's the principle here? Tax loss harvesting is when you sell a stock or an investment that is down, so has a lower basis, meaning the actual amount of money that is prescribed to it, than what you actually paid for in the beginning. So say you bought a stock for $50 and now it's worth $30, you sell it. Then for every single stock, you locked in a $20 capital loss. Now, why would you do that? Because you're losing money. Well, the idea here is you find a stock or some sort of investment that is just not doing well. It's kind of on the down, and the longer you hold it, the more money you're going to lose. So now you sell this lower performing stock, and because you lock in a capital loss of whatever that amount is, that loss is going to offset the capital gains that you have from higher performing assets somewhere else. So instead of paying the full tax rate on that higher performing asset, you have actually offset it either some or all the way. So that way you can take the money from that lower performing asset, invest it somewhere else, and at the same time, you are paying a smaller amount in overall taxes. Now, this does require a lot of discipline because you have to be able to properly analyze the various investments to be able to understand which are investments that you just shouldn't have your money invested in anymore, and not just something that has a minor slump that is partially down and you sell it, you lock in an actual loss, but if you had just held on to it a little bit longer, it would have gone back up, which overall, it's not worth trying to save on taxes by overall losing the money that you have invested, because you're always going to make more money by how much money you get on a capital gain than the money that you would save by using a capital loss, if that makes sense. Now, another area that is available to a lot of people, and I think is particularly powerful, especially for the middle class, is the ability to completely offset your capital gains when it comes to selling your primary residence. So the awesome thing here is that if you're single, married filing separately, you can save up to $250,000 in taxes on capital gains when you go and sell your primary residence if you've lived in it for at least 2 years. Now, this is awesome. So that means with how the housing market's been doing, if you bought a house that's $300,000 and then a couple years later it's worth $500,000 and you've lived in it for 2 consecutive years, you go and sell that house, even though you made a capital gain of $200,000 on that sale, you were going to pay taxes on $0, which is amazing. And then for married filing jointly couples, they double that amount, so you can save up to $500,000 in capital gains by using the same structure. So if you buy a house, let's say you live in it for a decade, and just based on inflation and how housing prices continually appreciate, you're probably going to have a sizable amount of appreciation in that property. And then when you go to sell it, you're not going to be paying any taxes on that, either up to the $250,000 amount based on your filing status or the $500,000 amount based on your filing status. And anything that is below that threshold, you are going to pay a goose egg amount of taxes on, which is all just money that goes straight into your pocket, which Uncle Sam is never going to see. And between tax loss harvesting and taking advantage of that tax break on selling your primary residence, that can easily save you thousands or even hundreds of thousands of dollars when it comes to taxes that you would be paying otherwise if you use those two strategies wisely. Now, I know for most people, the capital gains tax is not going to be where the majority of your money is going when it comes to taxes. Most likely it's going to be coming in the form of the federal income tax. So if you want to know a little bit more about how that's structured, check out this walkthrough right here. Thanks for watching, and from your first penny to your first million, we're here to help.